1031 exchange, more than a tax-advantaged real estate transaction. Although the primary reason many investors engage in a 1031 exchange transaction is to reap the tax benefits of deferring capital gains taxes on the sale of property, other potential benefits include capital preservation, cash flow maximization, portfolio diversification, transition to passive ownership, and to facilitate estate planning. Investors may want to consider a 1031 exchange if they own an investment property that is significantly or fully depreciated, not cash flowing as well as it could be, or is in an area without much appreciation in property value. Let's learn more. A 1031 exchange, referring to Section 1031 of the Internal Revenue Code, provides an alternative strategy for deferring the capital gains tax that may arise from the sale of a business or investment property. By exchanging the property for like-kind real estate, owners may push back the payment of federal and state taxes and use sale proceeds for the purchase of a replacement property. It is important to note that if an investor elects not to do a subsequent exchange, taxes that were deferred would be due. Because each investor's tax implications are different, they must consult with their tax advisor. Here's how a typical 1031 exchange transaction is executed. The exchanger determines they want to sell a property, known as the relinquished property. Once the buyer of the relinquished property is identified, the exchanger goes under contract, which specifies the sale may be structured as a 1031 exchange. The exchanger engages a qualified intermediary, or QI, to escrow the proceeds because the exchanger cannot take receipt of any funds in order to execute a successful tax-deferred transaction, and a replacement property is identified. The QI holds the funds until a like-kind replacement property is identified and uses the funds to purchase the replacement property on behalf of the exchanger. As a critical part of a 1031 exchange, the QI is a company that facilitates Section 1031 tax-deferred exchanges. The QI enters into a written agreement with the exchanger where the QI transfers the relinquished property to the buyer while transferring the replacement property to the exchanger pursuant to the exchange agreement. The QI holds the proceeds from the sale of the relinquished property in a trust or escrow account in order to ensure the exchanger never has actual or constructive receipt of the sale proceeds. The replacement property must be like-kind to the relinquished property. Some examples of like-kind properties include retail centers, office buildings, medical office and healthcare facilities, industrial warehouses, multifamily apartments, student housing, and self-storage. Any real estate held for productive use in a trade or business or for investment is considered like-kind. A primary residence will not fall into this category. However, vacation homes or rental properties may qualify. Consult a financial advisor to determine if a property qualifies for a 1031 exchange. The price of like-kind properties are not always the same. So in general, to execute a successful 1031 exchange transaction, investors should invest in assets with value equal to or greater than the relinquished property. Invest cash in the replacement property that is equal to or greater than the cash received from the sale of the relinquished property. The sum of the cash invested and the debt placed on the replacement property must be equal to or greater than the sum of the cash invested and the debt placed on the replacement property. In other words, additional cash can make up for a shortfall in debt placed on a replacement property, but additional debt cannot make up for a shortfall in cash invested in a replacement property. Once an exchanger sells the relinquished property, a replacement property must be identified within 45 calendar days. The replacement property must then be purchased within 180 calendar days from the sale of the original property. Here we show hypothetical examples of a property sale with and without a 1031 exchange. An investor owns a commercial property and sells it for $1 million. As shown, the net sales proceeds of $1 million is identical for both types of transactions. The original cost and capital gain are also identical. The major distinction comes in the form of taxes. The property sale without a 1031 exchange pays over $300,000 in taxes, leaving a little less than $700,000 available for reinvestment. For the investor that chose to execute a 1031 exchange, all taxes are deferred, and the funds available for reinvestment are the net sales proceeds of $1 million. Executing a 1031 exchange is an important tool to defer taxes, have maximum funds available for reinvestment, and grow net worth over the long term. Choosing the right partner that offers a variety of exchange properties to suit your needs may help maximize your investment return.